The S&P 500 hitting its 30th record close of 2024 yesterday as mega-cap stocks rally while the Dow snaps its four-day losing streak. Markets are great across the board so far this year. It's been a very strong year for the markets. There you go with the Dow, the S&P, and the NASDAQ in particular really showing gains. Let's bring in 42 Macro founder and CEO Darius Dale. Darius, we were talking about this yesterday that, the Journal pointed out that investors seem to have, volatility is low, numbers are good, that this is the calm before the storm. Do you worry about that at all?
Yes, but the reality is we need to time the storm, right, if we want to make money as investors. There are a lot of positive fundamental catalysts for the reason why this market is performing so well. Growth has been quite resilient in the U.S. economy. The labor market has held up, and inflation is actually starting to behave in manners that will allow the Federal Reserve to push through policy rate cuts. So it's kind of a Goldilocks environment.
I don't know. What do you say, Chris?
I like that Goldilocks environment. I think there are the Dow has got some room to run, right? The S&P has done incredibly well. A lot of that's pushed by tech, AI. We heard the term AI. We're talking a lot about that these days. But I think there's room in the Dow. The gap between the earnings per share and price per share on the Dow is big, and I think it's appropriate. And I think there are some signs of life on the horizon, particularly in the Dow stocks.
All right. So you're both fairly bullish, which is good. So there's the close yesterday. The Dow, we gained 188 points. Nice move. And again, that S&P, there's calls for 6,000 on the S&P. We'll see. Let's pull up the 10-year Treasury right now and take a look at that yield. Philadelphia Federal Reserve President Patrick Harker says he views one interest rate cut as appropriate for this year and would like, quote, several more months of improving inflation data. But we're going to hear from the Bank of England on Thursday. The UK is expected to hold rates steady there at 5.25%. So, if it comes down to the interest rate argument, do you expect that we're going to get a Fed cut in September? Do you think it would be after the election? What do you expect?
Well, that's a great question. In fact, we don't believe that it does come down to the interest rate argument. The reality is, again, as I mentioned, the economy has been resilient. It's going to slow over the medium term, but in our view, we think growth is more than likely to continue surprising to the upside. Inflation, if you look at our inflation forecast, they're likely to surprise to the downside over the medium term, which could create this Goldilocks vibe in asset markets. Now, this is not an all-clear signal from this starting point as an investor, and the reason for that is we are in an adverse spot in the positioning cycle. That you just said, we're starting to hear calls for 6,000 on the S&P. When you look at the variety of metrics that we track that help investors indicate where we are in the market cycle, a lot of them are starting to flash red from the perspective of medium to longer term risk. And so we're kind of late innings, if you think about it, picking up dimes in front of a steamroller, if you will.
Mm-hmm. Yeah, I don't know. The Journal also, Joe, made a point yesterday that, which I thought was fair, that with volatility so low, that investors are taking on more and more risk. And that if there is a downturn on the markets, that they're going to get punished for that.
Well, look, I think that's my concern. I think also, I know we're waiting for the actually retail numbers to come out this morning, but I think to that point, as you're looking at what's happening on Main Street, right, those individuals who have that debt for those vehicles, right, more people turning in vehicles where they have negative equity in those cars, right, more people having those cars repossessed. We now know that everything from the Klarna payments to the Afterpay payments, those micro lending rates are going through the roof. So do you see that as having an impact on obviously the retail numbers, which by exchange we're going to have an impact on what's going on Wall Street as well?
Which aren't inflation adjusted as well. So there you go.
Yeah, that's a great question you bring up, John. The reality is it's more than likely to have more of an impact on the election than it will have on the economy. I'll throw a statistic at you. If you break down consumer spending in the U.S. by income cohort, the top third of income cohorts account for 51% of total consumer spending in this country versus only 15% for the bottom third. So this has been a K-shaped recovery. It's been an increasingly K-shaped economy, and ultimately that's going to have political ramifications. But if you're talking about trying to get the stock market right or the bond market right, you have to think about things in the aggregate.
Interesting. Well, and there is a lot to consider, especially in an election year, which normally is good for markets. So yes. We'll see, Chris.
And the tidal wave of cash that's still on the sidelines, which is still significant, right? We see a little bit of an interest rate cut, and the Fed is a smidge political, and I think we'll see two. That's if we're guessing. And the reality is just that tidal wave, smidge, exactly, smidge.
Technical term.
Exactly, that is an industry term. But the bottom line is we're going to see two interest rate cuts. That cash is going to come pouring in, and I think was it Evercore? It was the lowest on the down. Now they're the highest. Seen the S&P. They went from last to first, saying 6,000 by the end of the year. I think it's likely to happen.
Yeah, I mean, the only thing that still concerns me a little bit would be obviously the shelter component of CPI. I still see that as a drag on the economy. Is there anything in that data that you watch that you key into, or no?
Yeah, absolutely. So that's the number one thing we're focused on over the medium term is the likelihood that we continue to see accelerated disinflation in shelter prices. If you think about shelter on the 3-month annualized basis in the most recent CPI report, we've hit lows we haven't seen since 2021. So that's actually quite good.
From an energy standpoint, do you see energy playing out here? I mean, obviously, we've seen the Biden administration trying to crack down on the new natural gas actual exporting. We've seen them basically trying to slow play what's happening with nuclear energy. Do you see any of that impacting much of the innovation that needs to be happening and some of the things that people are backing on Wall Street, the artificial intelligence that requires so much energy when we start looking at the chip manufacturing that we're trying to bring back home while at the same time not accounting for the rapid improvements we need to have in that energy sourcing in order to be able to meet those needs as well?
Yeah, absolutely. And this AI development, the development of AI infrastructure is likely to continue to create an excess demand for physical commodities, namely energy. We do believe energy and commodities are likely to continue appreciating over the medium term. That will cause a little bit of inflation. But the reality is if we continue to see an overwhelming disinflationary impulse in the larger categories of inflation like shelter, it will overwhelm that.
Yeah. The side hustle to what you're talking about is data centers. That's what Kevin O'Leary was telling me about.
Yeah.
Anyway, good to see you, Darius.
Thank you, Cheryl. Appreciate you. Thanks for having me.